Hi there, Alex Goldhagen here from TWP Club. Just wanted to spend a little bit of time today discussing the proposed CGT changes. So, what are the impacts to an investor, and what are the potential ways to not only protect myself in the future, but also potentially benefit from these changes? So, obviously, the news has been pretty loud about the CGT changes and potentially lowering that threshold. So, what does that look like for an investor, and how can we turn that into a positive for us moving forward? So, just jump right into it. There's obviously Treasury is examining at the moment a 33% deduction. So, they're looking at reducing the existing 50% deduction, which is allowed typically after 12 months of ownership of an investment property. If you sell an investment property prior to the 12 months, you do pay the full 100% basically worth of tax on that profit. So the profit is basically the difference between what you paid for the property and what you sold or disposed of the property for, less any of the fees incurred for the sale of that property. So obviously, the way I see this is you are being taxed on the income that you generate to save to buy the property. You're taxed on the income from the property. You're taxed then on the sale of the property. So tax after tax after tax. And that's obviously down to one reason and one reason alone, and that's to do with the government's spiraling debt position. We've got a video here. You can find that as well on our page, talking about the $1 trillion debt that's owed now by the Australian government. That equates to $47,600 per tax paying citizens. So basically 21 million people paying tax in Australia. That's $47,600 worth of debt secured by each taxpayer. Now, when you look at that, it's basically 2.5 times the annual tax revenue received from individuals, so the individual taxpayers out there. So 2.5 years of your tax just to repay the debt. Now, obviously, we can't look at reducing the debt. It will only increase all the while we have social programs and different policies that are designed to win over the public to gain votes and to gain traction. So obviously, there's not much we can do about that. We can make a bit of a fuss about it. You could protest, you can write to your members for parliament, but the reality of the situation is the government is desperately looking for additional revenue, and the easiest sort of targets are those that will poll the best in the media, and capital gains tax seems to be one of those things where people believe that it's costing the economy money, whereas the real question should be, where is the money being spent? But that's a conversation for another day. Moving on though, will this trigger the great sell-off? Will this result in people actually selling properties at an alarming rate so that they can avoid this coming CGT tax? Now, obviously, some people will be converting their portfolio more to the consolidation style phase, and any of those future dated sales, they may be brought forward sooner, so they can purchase those long-term hold assets. So if you are not selling the property, you are not incurring a CGT bill. Now, if the property that you're holding is a little bit older and needs repairs, it may not necessarily make sense to hold that property. You may want to sell that out, refresh that, get something that may stand the test of time a little bit better. But short term, what we'll see in the market is this will create obviously some opportunities. People will be selling, getting out of the market soon. And the reason I've got this little article here is sort of highlights the fact that somebody that sold this property was looking to sell this property back in 1972 in Leichhardt for $17,850. Now, I think every single person watching this video would find that money today. If that property in Leichhardt came onto the market at $17,850, we would all be jumping on that. We'd probably buy everything on the page, to be honest. But this will only push people into holding long-term those quality prized assets in those prized locations. So if you do have a really good location, it would definitely pay to hold onto those properties long-term, and potentially never selling those properties and not triggering the CGT tax itself. So what are the potential benefits of holding your property versus selling, you need to do the calculation there to see what that CGT would look like. The additional tax, unfortunately, there's not much we can do about taxes. So the fundamentals of property investing remain exactly the same, whether that's 100% CGT discount or 0% CGT discount. The whole purpose of you investing in property in the first place is to replace your income in retirement. We have a great ebook here, The 5 Keys to Wealth. Reduce debt, minimize tax, convert income into assets, protect your assets, and then look at generating all of your income from those assets in retirement. So obviously tax is only one part of the strategy when you're buying a property. Quality assets will always be quality assets, and you just need to look at your portfolio very pragmatically and remove the emotion from the equation and say, if all of the properties that I own today, if they were all for sale today, as a buyer, would I purchase those properties, or would I be saying, hey, maybe there's something a little bit better in the market for me? And looking at that again without the emotional goggles on, purely on the numbers, are the returns as attractive as they should be? Is your rental yield where it needs to be? Is that going to impact your ability to borrow in the future to buy more property? So, what are the opportunities that exist in the market? And again, I've got another video here which is talking about the next 5 years in property. But again, as I said, CGT changes or not, the demand for housing is always there and it continues to rise. We are not building enough property to support the population increase. So the demand for housing will continue to increase. So focus needs to shift to long-term holding as opposed to buying and selling property and trying to get a quick profit out of a property. But don't ruin your borrowing capacity, because once you've bought a property and if it's not performing, if it's not generating the income that you need, it will just drain your borrowing capacity and you'll be locked up and you won't be able to get into the next property from there. Some of the best property in the market right now, dual occupancy, housing, co-living, any multi-dwelling homes are great. And so too are the small commercial opportunities. Obviously, everyone would like to buy things like a childcare centre, that sort of thing, but not everyone has $4.5–5 million available. So where do we start? Looking at the smaller style commercial properties is definitely a good option for you. And the best way to avoid the CGT all up is not having to sell the property at all. So make sure you have your property portfolio in the right structure in a way that you can still transfer it to your children if that's the strategy, if that's the way you're looking at building your portfolio. Think about those things now. And when people say the cost of setting up a family trust or a company or a self-managed super fund is too high, I would refer you back to the amount of capital gains tax and other taxes that you'll be paying. You really want to be sort of comparing apples with apples and saying, if I buy it in my personal name, it's going to cost me this. If I buy it through a company, it's going to cost me this. And again, different structures apply to different people in different scenarios. So make sure you get the right information and the right advice. So just to show you that there are actually opportunities in those spaces, definitely available. One of my favorites at the moment, commercial storage units. They do return fairly well in terms of rental yields. I won't give you too many more specifics around numbers. If you're interested in this or the next project, then you can reach out to us directly. But commercial storage units, again, these are single contracts. So these would be potentially suitable for a self-managed super fund, as they are single contract, starting from $217,000. It's a phenomenal price, and as you can see, distance from Melbourne CBD, very, very close by. So great long-term hold for you. Very little repairs, maintenance. Tenants are taking care of outgoings, etc. So really good opportunity there. And then you've also got things like dual key house and land package on Dawes. Sorry, it's in Dawesville. It's on Melrose Beach. This is a $1 million dual key house and land package on the beach. For the same price point, we are looking at areas like Redbank Plains in Queensland. They're still good packages, but to be beachfront dual key house and land for me is an absolute no-brainer. I think it's a great opportunity there. Huge potential for capital growth. and very strong rental yield. Over time, you'd expect to see that increase significantly. So what are the next steps? If you are interested in discussing this further, reach out for a quick catch up, have a quick chat, a Zoom, phone call, review what your current situation looks like, go through then the game plan sort of template with you, which is let's work backwards from how much do you want to retire with? What does your current situation look like? Let's now allow for inflation and let's see how far away you are from your proposed retirement goal and really working towards understanding what the gap is, if any. And in most cases, there is a gap between what we have and what we need for retirement. And then once we know that, it then becomes very clear that we need to take some action. And what is the action? How much do we need? How active do we need to be in the property market? Or do we need to simply readjust our expectations for retirement? So hopefully you got some information out of that today. And again, if you'd like to have a chat with us, just reply to the email that we sent you or click the link underneath and we'll be in touch with you. Thanks very much, guys. Cheers.